Joining me now is Jordan Trimble, the president and CEO of Skyharbour Resources. Great to see you again, as always.
Yeah, thanks for having me again.
So you go to a lot of conferences, including recently the World Nuclear Association conference. We know uranium's in a good place right now. It's in favor. So can you describe and characterize the kinds of conversations you're having with people and the mood of people you're talking to?
Yeah, I mean, look, we're in a bull market. I think we're still very much in the early days of it. I think it's going to be a long-lasting, sustainable bull market. We've seen the price rise above $70 a pound, basically back to where it was pre-Fukushima. The WNA was a good litmus test for what we're seeing right now in the industry, where I wouldn't say it was absolutely euphoric. It's a conference that you basically got the full spectrum of the industry there, right? So you've got utilities, fuel buyers, governments, regulators, and then you have the mining companies and the suppliers. And notably, we've seen the market shift from a fuel buyer's market to a fuel seller's market. So the mining companies and the producers now have much more, let's say, leverage and ability to set prices versus being price takers over the last decade. And the bottom line is the market. There's a fairly significant structural supply deficit, primary mine supply deficit, about 140 to 150 million pounds of primary mine supply, and not growing that quickly, certainly not in the next few years, in the backdrop of rapidly growing demand, about 190 to 200 million pounds of demand globally. And we simply do not have, and this was talked about the WNA, we simply do not have the inventories, the secondary supplies out there to meet that supply deficit. We're seeing the market tighten up at all stages of the fuel cycle. So not just we're finally seeing U3O8, the uranium market tighten up, but we've seen the conversion and the enrichment markets tighten up quite significantly for a number of years now. So all the prices of these various intermediate products have been moving higher. And again, the first part of that, the U3O8 market, we're finally seeing that move higher as we talked about with the spot price. And we also they did a good job at the conference highlighting the need for new production to come online in the coming years, in particular in the West. And we'll talk about that a bit later, but the market bifurcation that we're seeing east versus west. But we need new mining projects to deliver, especially in Canada, in Australia, in the United States. If you look at global demand, well over 2/3 still is from the West and Western Europe, Canada, the U.S., Japan, South Korea. Now that's changing. We're seeing this new demand come from places like China, India, other parts of the developing world. China's planning to build 150 new nuclear power plants over the next 15 years. That's more nuclear power generation coming on and uranium demand coming online in China than has come on globally in the last 35 years. They talked about this at the WNA the last few years, but the advent of SMR, small modular reactors, this is a very important new emerging market and new source of demand. And that actually one of the key takeaways was just the nuclear fuel report that the WNA came out with at this conference. The new growth in demand is significant, up to just under 4% annual growth, up from just over 2%, 2.1% 2 years prior. So it's not just the supply side that's driving the price higher now. We're finally now seeing demand really ramp up globally.
You laid it out very nicely there. Can you sort of flesh out this concept of it being a fuel seller's market, and you've seen this over the course of 10 years where uranium was out of favor, nobody really wanted to touch it, to the point now where, as you described, it's the situation is reversed.
Yeah, look, a big part of that had to do with the fact that there was an abundance of secondary supply inventory. There was availability. If you're a fuel buyer, if you're a utility, there was material out there that you could buy, you could access relatively cheaply, and that put a ceiling on the price and downward pressure on the uranium price for a number of years. Well, we've cleaned a lot of that out now. The market's tightened up quite significantly. You add in the Sprott Physical Uranium Trust, Yellowcake, some of these new financial entities that have come to the market that have further tightened it up, and that's led to what we're seeing right now, which is the fuel buyers now. They can't buy it at the same price they were able to a few years ago, and the fuel sellers, the mining companies, the suppliers are now able to determine and set prices much more than they were a few years ago. And also a big part of this too, getting back to the contract market, the long-term contract market. So this is a key metric and number to look at, the contracting volumes. And we've already this year had contracting volumes north of 140 million pounds, up from 125 million pounds all of last year, and the previous few years before that, some years well below 100 million pounds. So the key number there is 180 million pounds. That's the replacement rate contracting number. And I don't know if we'll hit it this year, but we're getting awfully close. And I expect that we will see that number exceeded in the next few years. If you look at historically, in particular in the last 20 years, any year where you've had north of 180 million pounds of volume in the long-term contract market, you typically see a price spike in the uranium price. And so that's, again, it gets back to this point about the market tightening up, and utilities, fuel buyers are out there contracting, having to source new material going forward. And there just simply currently isn't enough new production coming online to meet that growing demand.
You mentioned the bifurcated market. We know the West is trying to wean itself off of Kazakhstan, Russia. So is that sustainable to be able to do that on a regular basis to wean ourselves off that? And also, will there be enough Western supply to make up for all the demand you're talking about?
Yeah, look, it's going to be challenging to do that. I mean, we're seeing this kind of gradually happen here. Things were expedited with the war in Ukraine and in Russia. Russia, Kazakhstan, and Uzbekistan collectively represent well over 50% of global primary mine supply. Russia has a stranglehold on the enrichment and conversion markets. That's why we're seeing announcements in the U.S. and Western Europe whereby they're looking to expand and increase their enrichment and conversion capacities, and we're going to need to see the West take a more prominent role at all stages of the fuel cycle going forward, including primary mine supply and production of U3O8. And we just simply, again, as we discussed, we simply do not have new large projects coming online in the West in the next couple of years to meet this growing demand, as the West needs to start relying more, Western utilities need to start relying more on Western producers. And you look at a place like Kazakhstan, which is, again, over 40% of global primary mine supply. Over the last several years, well over 50% of their sales and their revenues come from China. And I think we'll see Kazakhstan continue to gravitate more towards the Chinese and towards Russia, and supplying those markets. So again, Western utilities, Canadian, U.S., Western European utilities are going to have to start securing and locking up supply from Western suppliers, but the West is going to really have to ramp up production in the meantime.
Shifting gears a bit, Jordan, inflation has been with us for a few years. As we know, it's come down a little bit, but is sticky in certain areas. How has that impacted how you operate Skyharbour? And in a general sense, how do you think that's impacted the sector and how companies are dealing with it?
Well, I think from a macro standpoint, given the inflation that we've seen, it has an impact obviously on mining operations, development, and exploration, but it's increased the price needed to incentivize new production to come online. So, a few years ago, numbers that were talked about were, call it $50 to maybe $60 a pound that was needed to incentivize new production to come online and to ensure that current operations remain profitable. That number has only moved higher with this inflation that we've seen recently. I'd venture to say it's closer to $80 to even $100 a pound now, that you need to see to incentivize new production to come on to meet the growing demand and to make sure the market's in balance. So that's just from a macro standpoint, but from a more company-specific standpoint, look, it's affected all stages of the mining cycle, from exploration right through to production. I mean, we're an exploration and prospect generation business. We do have a few projects that are more advanced stage exploration, in particular Moore Lake, that we're working on a resource estimate at, and we're also looking at the potential for down the road, internally looking at the potential for ISR Sabre to be used ultimately to extract the various high grade zones at the Maverick corridor. But from an exploration standpoint, look, your drilling costs have gone up, your camp costs, your geologists, your, in particular, fuel costs associated with flying in and out of these projects. Now, one of the key benefits of this recent acquisition with Russell Lake becoming a co-flagship project with Moore Lake, Russell Lake comes with a lot of infrastructure. There's a road that services the McArthur River mine that runs right up through the western claims of the project. There's power lines as well, and significantly, there's a 40-person exploration camp that we're inheriting that Rio Tinto installed there about 10 years ago. So that really does help with these inflationary costs and pressures that you're talking about. In fact, our drill costs at Russell and now the adjacent Moore Lake project, because we can stage out of the Russell Lake camp, it basically kind of kept in check, in line with where they were previously. And we're able to drill there at a significantly lower dollar amount per meter than we would at other regional projects where it's fly in, fly out.
Well, that helps a lot for sure. Lastly, let's talk about the stock. As we sit here, it's up about 43% year to date. We're in a bull market, as you say, for uranium. Just wondering about, do you think the Skyharbour shares are just kind of out of the starting gate, so to speak, in terms of tailwinds in the sector? You've got a lot of catalysts coming continually, and there's always the possibility of a major discovery. And then the other part of that question is, how does a retail investor, for example, access Skyharbour instead of just buying the stock? There are alternatives, correct?
Yeah, there are. We're in most of the major uranium mining ETFs, and so if you own the ETFs, there's you'll have some exposure, small but some exposure to Skyharbour and several other of our peers as well. So that's been a good source of liquidity, and it helps make sure that the company and the stock trades in line with the sector, which is great. But we've got a great shareholder base outside of that too. We've got Denison Mines is our largest shareholder, a strategic that we've had as a shareholder now for a number of years. Dave Cates, the president and CEO of Denison, is a director of Skyharbour, and again, very close working relationship with Dave and the team there. Rio Tinto joined the shareholder register in the last year and a half with the transaction at Russell Lake, and they, through our earn-in at Russell, could become an even larger shareholder, as we do have an option to earn up to 100% of that project. We're nearing completion on the initial 51%, which we should have complete after this upcoming winter drill program. That'll be about 4,000 to 5,000 meters. And then we've got a number of funds, and uranium funds, resource funds, and some family offices as well. And so we've seen a shift from mostly retail to more of an institutional family office corporate shareholder base. Still have a very strong retail contingent nonetheless, though, and liquidity's picked up, which is great. And yeah, look, I think the market's obviously moving higher in this sector, and we're finally seeing some of the smaller and mid cap names catch up to some of the larger cap names, which you typically see as the cycle matures. And I still think there's value there with some of the smaller cap names and juniors. I don't think they've moved as much as they probably could, as we're seeing this uranium price continue to move higher. You still have a lot of the institutional and big money come into the larger cap names, the Camecos, the Sprott Physical Uranium Trust, some of the other, call it larger to mid cap names. And so that'll flow down into the smaller cap names as the cycle matures. But yeah, it's an exciting time for for these companies and for investors. Again, for us, it's we want to provide a one-stop shop, if you will, to high-grade uranium exploration and discovery, as well as prospect generation in what is really the best uranium mining district in the world in northern Saskatchewan in the Athabasca Basin.
Well, we've been doing these interviews for more than a year now, Jordan, and it's been fascinating to just follow the Skyharbour journey and to see it develop, all those things happening. So great to see you again. We'll catch up soon.
Yeah, always a pleasure. Thank you.
Okay. Jordan Trimble, he is the president and CEO at Skyharbour Resources. Thanks for watching, and we'll see you next time.